Hey, everybody. I don't know if you're picking me up or if you got cut off when I ended the session, but having some technical difficulties, not unusual. Don't know where the echo came from. The microphone then cut out altogether. So don't know whether you're with me or not. Hey, Andrew, are you picking up anything? Am I live? I am live. Okay. All right, I'll continue. Send me a text if you're not picking anything up, but I don't know if I don't see anybody on watching, so I'm going to just continue as if I am on. All right, thanks. Don't know if you guys are refreshing or not, and just want to apologize again for the technology issues. I get new stuff; it doesn't seem to suit me, or I don't suit it. Anyway, we were talking about Fed funds futures and the futures pointing to a negative rates in early 2021. So this is a quick turnaround from likelihood of events that only a couple of months ago seemed virtually impossible. I was on, I believe it was maybe Stuart Varney's show, Varney and Company, one morning, probably on the order of 6 months ago, somewhere about then. We were talking about rates, talking about the Federal Reserve, and he asked if we would ever see negative rates. I said no. If we were to ever see negative rates, something would be terribly, terribly wrong. And unfortunately, something is terribly wrong with the coronavirus, and that's impacted the economy, impacted all of us. And so now it looks like, according to the futures, that they are pricing in negative rates in 2021. How low, we don't know. The futures don't necessarily give that, but as they just dipped into that territory today. So that's news. It's certainly news if we go into negative rates. It's not impossible. It's probable now, because if the economy sinks as it's headed in the direction that it's headed, then rates, zero interest rates, which we have had for some time now, effectively we've had zero rates across the, at least for financial assets and for banks for some time. I know when you're looking at the federal funds rate, we're talking about a 0 to a quarter point for on Fed funds. We've had negative, we're not negative, but flat zero interest rates for banks for some time in every kind of emergency since 2007 and the 2008 financial crisis. So not unusual to see zero rates. We, of course, rarely ever are going to see zero rates on anything we do, though in Europe there are zero and negative rates on mortgages, as odd as that sounds. I don't know if we're going to get to that. I'm going to talk a little bit about mortgages today, at least commercial mortgages, and tomorrow I'm going to talk a good bit about residential mortgages. There's a lot going on both with CMBS, with commercial mortgage-backed securities, and also residential mortgage-backed securities. A lot going on with home ownership and with mortgage markets in general. So we'll touch on residential tomorrow. This afternoon, I'm just going to touch on CMBS for a minute. But back to the markets, we're widening down. We got 2.5 minutes to go, and we're slipping on all fronts. And again, I don't know whether that's I think I was cut off when I was talking about oil. WTI contract traded on the NYMEX this morning was up 10%. We're closing the day down around 3.5%. So that's a huge swing in oil. I think there was some optimism that if there is demand for oil, if the price of oil is going up, then maybe there's growth starting to percolate, green shoots, if you will. Hardly any green shoots anywhere of any measure of any consequence. So it's not really about demand. It's about the idea that the Saudis were going to cut discounts that they were offering to a lot of buyers of their oil. That's what spiked the oil markets this morning. That seems to come down, as maybe there's some further news on oil that I just didn't pick up on. So as oil goes, sometimes so goes the market. There's been some correlation between oil and equities for a couple of weeks. Not a tight correlation, but there is some correlation. And generally speaking, there is over good periods of time, long periods of time, there is a correlation between price of oil and economic growth and GDP growth, and also some related markets. Couple of metrics we can't not talk about today because economics, the economy, the metrics regarding the economy are all important to us. And you, I believe, understand and know my supposition, which is the weight of the economy will eventually weigh on the buoyant markets and knock them down to more realistic levels. Today, initial unemployment claims for the week ending May 2 came in at 3.17 million. Now that's a downtrend, if you will. So we're looking at peak to trend wise, we're on a downside of the trend. Now, whether or not that can continue is anybody's guess. The expectations by one analyst that I heard from a European bank who is very well noted, in my opinion, I think a very good analyst on U.S. issues. He said he didn't think that we would see less than 1 million per week signing up for unemployment benefits through the end of June, maybe July. So even though right now, based on a couple of weeks, it looks like we peaked, looks like we're trending down. 3.17 million is a huge number for a week in terms of people lining up to get benefits. Some of the systems are still having problems, and however, the trend does look supportive of peak having had happened. So some of the interesting breakdowns indicates that that may be true here, there, but certainly not everywhere. Michigan, for example, saw 69,000 claims for unemployment benefits this week. That's down from a peak of 389,000 the week ending April 4th. So that's a 17% drop from their peak, when that was the peak week for Michigan residents. And in Michigan, workers, 1 in 25 Michigan workers work in the auto industry. So we know the auto industry has been affected, and it'll be nice to see some reprieve for those workers. Arkansas, Ohio, Pennsylvania, and California were among 16 states whose claims benefits dropped 70%. So 70% reduction from their peaks to this week ending May 2nd. That's a big drop. So, and that's more than 70, at least 70%. So Arkansas, Ohio, Pennsylvania, and California, and there were 12 other states that saw a 70% drop in from the peak to this week's benefits claims. So that's positive. Oklahoma, Connecticut, New Jersey, New Mexico, Maryland, and Maine saw increases. So a bit of a mixed bag, some hopeful signs. However, I don't think that, given some of the horror stories that are out there, people not being able to get onto unemployment sites to sign up for benefits, I think there's probably still a backlog. And we'll find out next week. We're going to get these numbers weekly. The continuing claims numbers, 22.6 million. There's no reduction there. There's an increase there. So what we're seeing is an increase in continuing claims, meaning we would like to see continuing claims flatten and then eventually drop a little bit, because that would indicate that PPP, the payroll protection plan, which grants loan money, which becomes grant money to businesses who rehire their staff. And we're not seeing that. So that's not working. PPP is not working to take people off of the unemployment rolls. That's not a good thing. And again, we talk about this every week. Continuing claims are going to be as important going forward, and eventually going to be more important than the initial unemployment claims. Tomorrow, of course, we get a huge number. We get the unemployment levels. Really, I'll just narrow it down. The consensus seems to be 16 million unemployed, and don't forget. That's a horrendous number. That's percentage-wise, excuse me, not 16 million, 16% unemployment. Put that in some perspective. At the worst period of the financial crisis, unemployment got to 10%. So we are already above that. Presumably, the low end is 13%. The high end I've seen is a touch over 20%. The consensus seems to fall in at 16%. We'll see that number tomorrow. We'll get the breakdown then, and we'll talk about that in the afternoon. Other interesting things today. Neiman Marcus declaring bankruptcy. It's going to go into sort of a prepackaged bankruptcy where the debt holders are going to take over the equity. Now, this is a Neiman Marcus was taken private in a PE deal, private equity deal, but it's indicative of what's going to happen, I believe, to Nordstrom. We've talked about Nordstrom. Neiman Marcus had over $5 billion in debt, and Nordstrom has close to that amount. They're just maybe a shade under $5 billion. Neiman Marcus is a shade over $5 billion in debt. But with the lack of cash flow and presumably no one knows how consumers are going to react and go to the stores or not go to the stores. And obviously they're not shopping enough online at these big retailers to sustain them, especially with their long-term leases and some of the property that they do own. So I'm still on the camp of Nordstrom being an opportunity to make money on the downside. Again, Neiman Marcus just sort of corroborates my thinking on that in terms of what's going to happen there. Just to make clear, a lot of folks think, okay, if I get into something like a Neiman Marcus, if it gets hurt, it'll battle back. And if it goes bankrupt, I have a problem, and you're going to get wiped out in terms of the debt. You need to understand, for all of those of you who like to speculate in some of the cruise lines, in some of the airlines, some of the really beaten down companies, some of them are going to declare bankruptcy. They are going to continue to exist. It's not a matter of are they going to exist or going to continue as an ongoing concern. Yes, a lot of them are going to continue as the kinds of concerns we know them to be, except if they declare bankruptcy, it wipes out the equity holders. That's the stockholders, and the debtors become equity holders, owners in the company. And that's the deal. Debtors know there aren't enough assets to pay them off. And the only way they can get paid off to their satisfaction is to become equity owners, to provide additional financing to the companies to keep them going in order to give them a chance to build themselves back up, to make that equity that the debt owners now have 100% of worth something. So be careful about speculating in beaten up industries where companies might declare bankruptcy, because the equity holders are going to get wiped out. And because I bring that up because people are, and I've already gotten questions today. Some folks, friends of mine, have called me up and talked about Neiman Marcus and what does that mean for Nordstrom? What does that mean for other retailers? And I just had to explain that the debtors become the equity holders. So it doesn't mean the company is going to disappear. A lot of these companies are going to just be remade. And that means equity holders wiped out, debtors in control. So be careful if you're out speculating on some of these companies that are likely to BK. We were closed, and a little bit of pop into the close. We didn't close on the lows, so we'll take a quick look at that. But I want to see if there's anything else I want to touch on here. Talked about negative rates, talked about Neiman Marcus and bankruptcy. We know that there's going to be more of those. I'm going to we'll start to put together a list for you of potential bankruptcies, stocks to actually buy puts on or short. And we'll come up with a few lists. I'm going to come up with a retail list. I'm going to come up with another list. I'm also going to talk about a little bit about commercial mortgages and some opportunities there. I'm not going to give you opportunities today. I'm going to give you those next week. I'm going to do a little more digging for you because some of those are difficult plays, and the Federal Reserve may come in to do something. It's going to have to, I think, come in to do something for commercial mortgage backed securities holders. And we'll get to that right now. So those are the metrics today, the ugly metrics today. Some metrics that I just wanted to impress upon you how bad things are. Looking over in Europe, things are terrible in Europe. By one measure, according to the Daily Telegraph, half of the adult population in the UK is now being paid by the government. Their wages or income, whatever that is being paid by the government. Half. That's frightening. I don't think that the United States is going to get to anything like that. But if we see unemployment at 20%, unemployment at 30%, which is entirely possible as this recession, I'm going to call it a recession come depression, because that's what it's going to look and feel like happens, we could get to 30% unemployment, a staggering number. But if it's happening in the UK, it could happen anywhere, and certainly we're not out of the woods. A couple of other ugly numbers. U.S. household debt has been rising. It's been rising over the last 23 quarters in a row. Now stands at a record $14.3 trillion. That's according to the Federal Reserve Bank of New York. It had reached a high of $15 trillion in 2007. So it's still shy of that, but at 14.3 trillion, households have been piling on debt. That doesn't bode well for consumption. And those numbers are going to increase as households put goods and services on their credit cards, refinance their homes in order to, and that's borrowing, make no mistake about it, in order to consume and live. So the household debt is going to increase. It's going to make driving the consumption economy, which is what the United States has, harder and harder as household debt increases. And tomorrow, again, we're going to talk about residential mortgages, and we'll talk a little about rent, but mostly residential mortgages and the impact that the coronavirus is having on that, and what that's going to do to the economy. So we've got a lot of ugliness ahead of us there, and it's only just beginning. Some of the numbers I'll give you tomorrow in terms of where we are relative to where we were and how long it took us to get to where we are now in the last Great Recession of 2007 to 2009. Some of the metrics are frightening in terms of what has taken us now less than 5 weeks to get to, took 2 to 3 years to get to in the last recession. Just staggering levels of debt, staggering levels of indebtedness, staggering levels of forbearance, and all kinds of other things. That means things are just still building. Nobody's going to be relieved of their debt. Maybe there will be some magic, but the debt is piling up on the back end. So household debt is very important to keep an eye on. Household debt is, let's see, it actually increased 28.2% in the second quarter from the second quarter of last year. That's a huge, that's a monumental increase. So total household, okay, we covered that enough. Mortgage debt is now up to $10 trillion. It's up $150 billion year over year. For example, we're at $10 trillion in the first quarter. It was 9.71 trillion. We've gone in one quarter from $9.71 trillion in mortgage debt to 10 trillion. That's a substantial increase in a quarter. Home equity, meantime, has gone down 0.39%. So we're seeing a decrease in home equity, and an increase in mortgage debt. 80% of mortgages originations had a score of greater than 720. That's the highest in 7 years. So there is some hope, but that over the last half year, 80% of originations were to folks that had credit scores of 720 or better. That's good. That's a positive. So we'll hope that continues. Auto debt at $1.35 trillion. It's been rising for 36 consecutive months. Credit card delinquencies rose to 9.09%. That is the highest in the last 2 years. In the first quarter, 189,000 consumers had bankruptcy notations on their credit reports in the first quarter. So that's an awful lot of bankruptcies in the first quarter. And don't forget the deepest impact of the coronavirus didn't happen till later in the first quarter. So staggering numbers. And unfortunately, those are going to continue. But I like us to keep abreast of those numbers. Before we go to the markets close and where we are support and resistance wise, just want to touch on commercial mortgage-backed real estate, commercial mortgage-backed securities. Commercial real estate, as opposed to residential real estate, is office buildings, all kinds, every kind of commercial building that you can think of falls into that category. So these are not homes, and the market for commercial mortgage-backed securities is absolutely gigantic. It's probably, the numbers are varied between the Federal Reserve and some industry numbers, but it looks to be about 500, between 500, I'll give you the range, between 577 billion and 584 billion in commercial mortgage-backed securities, not in mortgages, just in the securities. So we'll talk about a $584 billion market for a particular kind of securities. Now, these aren't subprime securities, obviously. They're not residential securities, they're commercial mortgage-backed securities. But there's a huge problem with CMBS. According to data compiled by Morgan Stanley, there was a record 666 commercial mortgage-backed securities loans totaling $1 billion went newly into delinquency in the last 4 weeks. So that's a record. That's the largest month-over-month record. There was a total of 324 loans with a total balance of $4.8 billion currently delinquent. So again, just month over month, the increase is staggering. And then in the first quarter, the numbers are pretty high. Those are all-time highs. Now, delinquencies in commercial mortgage-backed securities are if a borrower is 2 months past, 2 months delinquent. That's considered a delinquency. 1 month, they can not pay interest, and it's considered a late beyond a grace period. So those aren't, we're talking about 2 months and beyond. So not in between the 2 months, we're past the grace period in terms of the numbers I'm reflecting here. Fitch, the ratings agency, says borrowers with mortgages representing almost $150 billion in commercial mortgage-backed securities. That's, according to Fitch, that's 26% of outstanding commercial mortgage-backed securities asked about suspending payments in the last 2 weeks. $150 billion worth of commercial mortgage-backed securities. So these are the loans that underlie the securities. The holders of those loans who are not able to pay are asking the servicers if what they can do in terms of forbearance. So the numbers are staggering. After the financial crisis, foreclosures in commercial peaked at 9%. That happened at the trough of July 2011. According to Fitch, we could be at that level by the third quarter of this year. A staggering amount of time. So we know that the foreclosures from the recession, which technically lasted from 2007 to 2009, didn't peak till July 2011. Fitch believes they're going to hit 9% default rate by the third quarter of this year. So some staggering numbers ahead. And it's not about valuations yet. It's about cash flow. The loans aren't being able to be met and serviced because the underlying properties don't have the cash flow. So borrowers don't have the cash flow to meet their minimum requirements on a monthly service basis. So staggering amounts of debt there. That has implications for funds. that hold these debts. Mutual funds hold these debts. A lot of trading desks hold these debts. A lot of speculators hold these debts. They're held in pension funds. They're widely held. Why? Because they have high yields. So this is part of the problem. A lot of these loans are leveraged, and you have another part of the CMBS group. You have leveraged loans of commercial mortgage-backed securities, and the leveraged loans are to hold loans that are made to commercial industries like hotels, for example. So some of the hotel loans are already in default technically, and they're being worked out. So the ones that are in default are some very old hotel lines that you probably haven't even heard of. Some they're private, but they're not doing well. So the big names, the publicly traded names, so far staying clear of that, but they're heading in that direction. Room rates, revenue per room rates are non-existent. Some of the numbers on that are pretty frightening. Let's see. It took 4 years for hotels to recover their revenue per available room after the 2008 crisis, which the actual recession ended in July of 2009. It took 4 years after that for hotels to recover their revenue per available room. That's staggering, and so this makes the previous Great Recession look like a day at the beach. So the older limited service hotels are already in trouble, and according to some of the rating agencies, they and retailers are not. A lot of retailers are not going to make it. Also, a lot of those loans that went to retailers for the commercial buildings that they are housed in, same with the hotels, are packaged in commercial mortgage-backed securities, and so increasing problems there. Last note on that, 60% of 2,000 hotels surveyed by a real estate tracking firm, CBRE, said that in April, 60% of 2,000 hotels surveyed said they had 2 months or less worth of reserves to meet debt obligations. Okay, that says a lot. I'll repeat that. 60% of 2,000 hotels surveyed said they had 2 months or less worth of reserves to meet debt obligations. We're going to see a tsunami of bankruptcies and defaults. First, we're going to see the downgrades, and then we're going to see the defaults. So let's take a look at the market. Now, I want to give you a couple of interesting, I think very interesting and fun ETFs to take a look at, stuff you may not be aware of, but it's just fun stuff. So real quick, let's go to the videotape, as they say. Dow Jones Industrial Average close at 23,875. So let me make my notations. 23,875, the high on the Dow. 24,094. We got above that 24,040 level that we talked about yesterday as being resistance. We know that our next level above there is 24,120. We didn't get up to that at 2490 in the high of the day. We didn't quite get up to there. So we're right back down, and we closed below the 24,040 resistance. That's been a level that's been hard to breach for the Dow. On the low today at 23,834, we came right down to support of 23,840. So pretty much intact there within this range. A lot of activity today, but really net, not a lot happened. Things look pretty bright in the morning in terms of the futures, in terms of the possibility of going a lot higher. That wasn't to be. S&P. We ended up 111 points in the Dow, but we're nowhere. We're still absolutely nowhere. We need to be above 24,000. We need to, if we were between 24,000 and 24,250 or 24,500 and consolidating there, that would be a real positive for the market. I see this as a problem for the market because it's just not able to break out convincingly, and it's trying to consolidate here. We'll see. It's going to have to do a heck of a job of it. And right now, I'm not convinced that it's doing enough work to get out of the trading range that it's in. S&P, we closed here at 2881, up 1.15%. Had a pretty good day there, but still not impressive in terms of breaking out anywhere. The high, 2878. So there we closed fairly close to, excuse me, that was the open, 2901 was the high. So had a good run, couldn't sustain it, but didn't, all in all, not bad. Lows 2876. We closed closer to the lows and the highs by far today, in terms of where we were. So that's how good a day we had. We gapped open, which is a positive most of the time if there's momentum behind that. But oftentimes when you gap open, especially in these kinds of very volatile markets, that gap needs to be filled technically for a lot of different reasons. And what happens is the market will come down and fill that. I can see a couple of questions. I'll be happy to get to it in a minute. That closing at 2881 and high of 2901. On the high, we got out of the 2898 resistance. The next resistance was we got through 20. We got up to, but that's the last resistance of import, 2898. Got through that and stayed short of 2930. Next resistance above 2930 is 2954. That's a 61.8% Fibonacci retracement from the low. So that's a pretty 2954 is going to be an interesting resistance point for S&P. On the lows, 2876 was a low today, and we came right down to about 2863, which was our interim support right here. We've got support below that at 2821, below that 2797. So that's all we need to talk on there. And on the Nasdaq Composite, once again, the star, not surprising. Nasdaq Comp closed at 8,979 and change. The high was 9,015, and the low is 89.32. So at 89.79 close, we got above resistance at 89.09. We got above 89.26. We have a huge gap between 89.26 and 9,000. There's some other numbers in there I'll fill in tomorrow for you, but we got that kind of gap on the Nasdaq Composite. Then leadership-wise, everyone's looking to the composite to lead higher. And with that kind of gap between the last resistance at 89.26 and then the next resistance at 9,000, yeah, that's a nice move, and it'll happen very quickly. It can happen, and once we get there, the next resistance really is we're looking about 99,250. So we got these large gaps to get there, and we're really close to that 9,000 level. We got over it today. There's nothing but clear sailing above that. So again, Nasdaq Composite, if it continues to lead, could possibly pull the other markets up, but we're not there yet. We did get above there today, which is the first time in a while, and it looks, it better be the continued leadership role, because if not, then we got trouble. All right, I got a couple questions real quick, then I'm going to talk about these ETFs. Russ asks, is it a good idea to move your money market cash into bill? Well, yeah, I'm just not a fan of money markets because of what happened in 2008, and the money markets have already had to be rescued. I don't. Bill has pretty good volume. That's the Bloomberg Barclays 1 to 3 month T-bill. I don't know what the charges on that are. Russ, you need to take a quick look at that and see what the fees are. I think it should be low enough. But as you can see, it's pretty steady. It's probably a good place to park your money. Yeah, I think that's pretty good bet. The volume is 2,271,000. So you got some pretty good volume in there. It's got a pretty decent yield. I would just, I don't own it. I have not parked any money in there, but I suggest you take a look at how that is held. If it's held directly in 1 to 3 month bills, perfect. If it's held with any derivatives, I'm not so sure about that. So just take a look at the actual holdings. If they are holding the bills, then yeah, I like it a lot. I don't know how they get that yield at 158. That's something you want to take a look at. But I don't like money market funds because they invest in corporate IOUs, and the Federal Reserve is already backing the money market funds, ladies and gentlemen. So be very careful about money market funds. They're not going to be allowed to go down. But don't forget, you've got the proverbial dollar, and now that dollar can be broken. In the old days, the dollar was sacrosanct. If you put $1 into a money market fund, you could get $1 out, and they never broke $1. So the Prime Reserve Fund, which was the largest, really the first and the largest money market fund in the world, broke the buck in 2008. Now the Federal Reserve wants everyone to know money markets can break the buck. So you can actually lose money in a money market. You really can't lose money in T-bills. Whatever the interest rate is, it is what it is. But you're guaranteed your principal back because they're guaranteed by the federal government for whatever that's worth. Let's see. Mike asked me, would you please address stock SH? SH is it's a great way to play the market to the downside. It's the ProShares short S&P 500. It's not leveraged. It's 1-for-1 with the S&P. If the S&P goes up 1%, SH should go down 1%. ETFs don't track 100% the way they should, or that we would like them to be tracking, the way the sponsors would like them to track. But the differences are they're manageable, and I wouldn't worry about it. I like SH. If I think the market's going down, I buy SH. I like SH now. I like SH down here. For me, I like SH down here, and I would buy it down here and maybe put a stop on if the market continues to rally, and maybe put a stop at I like 22.75. I've already looked at SH. That's why I know where I would put my stop in if the market was going to continue to rally. If you're looking for a hedge, if you're looking for a place to try and play the downside, SH is pretty good. It's not leveraged. A lot of folks like 2x and 3x leverage because they want to get a real bang for their buck if the market crashes. This is more of a hedge type position, or more of a steady type position that I think, in other words, if I wake up, I don't mind holding this because I don't think the market going higher is going to kill this, and it hasn't. But if the market falls out of bed tomorrow, at least I have a position on. If I have this, I will then go, if I see the market breaking down, I'll certainly add a lot more downside positions. But yes, I do like SH, and I like it in here. I think it's a worthwhile play down here. The lows, the 52-week lows are 22.82. So that's another reason that I would put a 22.75 stop on there. It's just below the 52-week low. If we get there, then obviously the markets are going higher, and you don't need that. Doesn't mean that the markets can't go higher and then turn around, but I usually like to limit my losses on something like that. If, however, I had that position in SH and the market was going up and I thought it was getting far too frothy, I would even consider adding to my position if SH came down. It really is a function of the markets. You know that I don't like the market. I think the market is going to give way at some point. So for me personally, if I have a position in SH and I don't like the market and it's going higher and higher, and I think it's beyond frothy, and I owned a position, I would average down for sure. So that's hopefully that helps you there, Mike. Sam asks, hi, question, what are your thoughts on Groupon? Okay, Groupon is, it's surprising to me that Groupon hasn't done a little bit better since it's been shorted so much. It's not a stock I own. I don't particularly like what the company does anymore. I had a friend that was in that business, made a ton of money when that business was a really good business. He did not take his company public, but made a lot of money and sold it. And I asked him why he got out of it. He said it's getting too competitive and it's getting too expensive. Groupon, I guess, was the premier company in that field and probably consolidate some other companies and ran the show for a while. But you can see by the stock that it's just been a loser. So I'm not inclined. I haven't followed up on Groupon in a long time to see what they're doing, if they're doing anything different. I'm surprised. I guess you can see the spikes. I'm looking at the chart, and I can see, Sam, I can see some of the spikes in there, and I don't know because I haven't dug into it, but I would bet those spikes higher are probably short covering rallies, and then the stock seems to come right back down. It is trying to make higher highs, and it does have a huge gap to fill. It's a kind of stock at that price that I used to like to speculate with. So I'll take a look at it. Thanks for bringing it to my attention. If you're going to play it to the upside, I presume you would play it to the upside, because I look at a stock like that and I see it's been battered. I also see it trying to make new higher highs as it comes off the floor. And then I see a huge gap. And I often think that if the stock can do well, and it's going to take the market to do well, it's going to take the economy to do well for Groupon to do well. If it gets above $1.50, it could get to $2. So yeah, that would be a very nice percentage move. So yeah, it's something to look at. Thanks for bringing it to my attention. Those are my thoughts there. Hope that helps you out. Martin asks your thoughts on OLLI. My first thought is that I don't know what it is. So I'm looking at it for the first time, Martin. OLLI is Ollie's Bargain Outlet Holdings. Don't know anything about it. I'm just looking at a chart of it, and I see it's had a nice move off the bottom, but I would note that it has been declining. It's been in a decline for some time and got some strange gaps there. So it's not a consistent trader. I'm going to go out a few years and take a quick look. Boy, it's got some pretty crazy action over 4 years. Had a tremendous rise. Yeah, it's interesting. I would have to take a look at it, but from the chart, I will say this about that. It might be worth a speculative ride higher because of what it's just done. I'm looking what it's done here, and it looks like it's trying to break out to the upside. So I would be careful with it, and I apologize, I don't know more about it, but I'm just giving you the read from the chart on it. Hope that was of some help at least. Clint is asking, buy on PHK and RCS. Okay. PIMCO High Income Fund. No, I wouldn't buy it right now. I just think if you look at what happened to it, fell off of that cliff that it was on. I don't know that high yielding stuff is going to do really well. We know that the Fed's probably got applied the put underneath it, and then they're going to have some support. But I wouldn't speculate on this going a lot higher. The economy is going to put a lot of pressure on high yielding debt, and PIMCO's high income fund, again, it's had a nice recovery, and you look at where it's come from, which was was a lot of people looking at where stocks have come from as, oh my gosh, if they go halfway back there, a tremendous move percentage-wise. If they go all the way back there, I'm hitting it out of the park. I look at it that way also, except I look at it in the context of the economy, where I believe we're headed, and also in terms of the particular instrument. Here, in terms of high yield, there's so much pressure on high yield, and unless you knew exactly, not exactly, but it had a really good picture and a good understanding of what the holdings were in what areas, what debt, who were the debtors that the fund is holding, that would be more telling than anything else. Without that knowledge, I wouldn't go into it. I'm not into the high yield debt right now. I think the spreads have narrowed considerably, far more so than they should have. Spreads over treasuries, the spreads over swap rates have narrowed, and that's a positive sign. When spreads narrow, they compress. That's a good sign. It's when they widen that things are ugly and getting uglier. So they widen significantly. Now they're compressing. So the spreads are coming down. Again, that's a good thing. I think they've come down too fast. They've compressed too fast. And I think that the risk premium for high yield debt over risk-free rate of return is not worth it. It's too much of a risk for me. They're not paying me enough premium over risk-free rate of return, or over a AAA for that matter, for me to go chasing that kind of yield. So that's how I feel about that. And the other one you had was RCS. That's the PIMCO Strategic Income Fund. I'll give you the same story, Clint. I'm apprehensive about high income debt, high yield debt, fallen angels, junk bonds. You're looking at 10.89 yield. That's a junk portfolio. So I'm apprehensive that that has a lot more upside to go. The economy has to be doing well. These companies that have issued debt have to be able to refinance. They've got to be able to meet debt service consistently. They have to be out of, in my opinion, out of the reach of the rating agencies who are hovering over these companies now, ready and willing and able and soon to start downgrading them. So I don't. It's not my cup of tea right now. A couple more, and then I'm going to get to these ETFs that I spoke about. KSS. Kohl's has struggled, and in the big box space, there are certainly some winners. Walmart winner, Target absolute winner. There are going to be winners and there are going to be losers. And Kohl's may be a loser. The stock has not performed. It has been a laggard for some time. Buying it down here is a question of whether you believe it's going to continue to be able to open stores or start to open stores, and people will go there, as opposed to other stores that apparently they've been going to a lot more so than Kohl's. So if you just take a look at the stock, it hasn't bounced off the bottom. I'd be apprehensive about it. It is cheap by pretty much every measure, and maybe there's a reason for that. So I'd just be a little cautious on Kohl's. I'll do a little more looking into it because I used to like Kohl's. They fell out of favor with me about 2 years ago, and I stopped following it. So I'll have to get a little caught up on that. Roger, quick explanation of high yield debt. I'll be real quick. High yield debt, Rogers. I'm going to give you the modern version of high yield debt. Michael Milken, who you may or may not know, Michael Milken did his MBA work at Wharton and basically did it on fallen angels. Fallen angels are corporations who have issued debt, who were once highly rated, and the debt falls out of favor, it gets downgraded, and it falls into poor quality levels. It's down. Maybe it falls into, it's below investment grade. Let's put it that way. And those used to be called fallen angels, because once the debt was premier debt issued by companies that everybody figured that debt is a sure bet, I'll certainly lend them money. And when the debt falls, it becomes a fallen angel. Michael Milken did his thesis on fallen angels and said if you bought a large enough diversified portfolio, held a diversified portfolio of fallen angels, then the yield you would get out of that would be more than enough to offset the occasional defaults you're going to get in a well-rounded portfolio. And he built a very successful career on that, and he built the junk bond industry. He didn't like the word junk bond, the term junk bonds. He made his people, his desk was in Beverly Hills. He made them call it high yield. So high yield is junk, are fallen angels. That's what they are. The problem now is not all junk are fallen angels. So if fallen angels refers to a company that's a solid company that once issued debt that was investment grade that's fallen, a lot of the junk that's issued now comes out as junk. It's not debt that has fallen in because of ratings and or just because of inability to service and or just the price falling. A lot of junk comes out now as junk. It's issued by companies as junk. So why would a company issue high yield debt? Who would buy it? Yield hungry investors. That's who. So if you're struggling, and a lot of the debt that has come out over the last really 10 years, a lot of the junk debt is debt that's been issued, high yield debt that's been issued at high interest rates by companies who are already leveraged and they got destroyed in the Great Recession. They are they're called, these are the zombie companies that even the Bank of International Settlements points to in the United States as being a problem, a mega problem. These companies are still alive. They should have been bankrupted long time ago. They're still alive because they are able to continue operations, whatever that means, not profitability, but operations, because they're able to continue to issue debt. Right? They roll over their old debt in order to stay alive another 2 years, 3 years, whatever they can get. And the buyers of that debt package it into high yielding debt instruments, and they sell it in terms of loans, whether it's collateralized loan obligations and all kinds of different structures. And so that's the whole high yield market. That's the junk market. A lot of them, I don't call them fallen angels anymore, because that was the original class of investment grade debt that fell. Now junk bonds are junk bonds. Hopefully that answers your question. Hopefully it wasn't too long-winded. Gold is up. Is it a good time to sell or better to hold? Doug asks. Doug, we've talked about gold for a couple of weeks now. There's no reason to sell gold. I don't see a reason to sell gold. There's been a lot of buying. There's been international buying. There's been sovereign wealth fund buying of gold. There's been central bank buying of gold. So I don't see a reason to sell gold. If you got a nice profit in it, I say keep riding it. There's talk about gold going to 2,000, 3,000. A lot of that is maybe speculative and hopeful thinking, but the trend is up, and until it changes, I say try and ride it for as long as you can, because in this environment, especially with money printing, traditionally, if there's a lot of money printing, you're devaluing the currency, and that means that a hard asset like gold has more value, may have be more of a store of value. That's the theoretical thinking, and it has been the theoretical thinking. Whether that's true right now, or whether gold as a shiny metal object that people want to hold, or the belief system that it is store of value, or whatever other reasons that people have, I don't know. There could be many, but doesn't matter to me. Is 1 or 30, gold's going up. There's more buyers and sellers. As long as it continues moving higher, I say stay along for the ride. Okay, Darry asks, any thoughts on DHT? Always have thoughts. It's I'm going to have to take a deep look into it. The chart is all over the place, Darry. You own it. You sold calls. You bought them back. We sold them. You're still in it for now. Wow, that's a volatile. That's a lot of volatility in that chart. I don't know. I'll have to look into it. Shoot me that question tomorrow. I'll take a look at it and I'll give you a better answer tomorrow. So I apologize that that's not a company I'm that familiar with, but I certainly am interested in it with the yield and the PE. Looks interesting to me. It looks like a good trading stock. So thanks for the heads up. Roger asks, do we know if the central banks have been big buyers of gold? Yes, some have. How big, we don't know because they don't usually tell us what they're buying. But I do know that central banks have been buying gold. Not the way they used to, and not, I believe, because people think that we're going back to a gold standard. That's not going to happen. That's never going to happen. Theoretically, it's not possible. You can't expand gold enough to be able to expand the money supply in order to meet a growing economy, especially one starved of capital, especially in the kind of environment where we're now. It would be impossible for the Federal Reserve, for this country to do what it's done in terms of backstopping capital markets, in terms of helicopter money, if we were tied to a gold standard. Couldn't happen. We couldn't possibly issue enough money without going off the gold standard. So that's why we'll never go back to a gold standard. The idea of it theoretically is good. It's antiquated as far as I'm concerned. More than that, it's antediluvian. It's not. It's just old. But doesn't mean that just like the Japanese central bank buys equities and ETFs, just like the Swiss central bank is buying U.S. equities and buying gold, and Japan is buying gold. So these are the Russian central banks buying gold. So yes, they're buying gold as an investment. They're buying it because of the same reason you look at the chart and you see it going up, because they think it's going up and it's going to be a store of value, especially as countries around the world are going to theoretically devalue their currencies. So yeah, so gold. Enjoy the ride. Let's see. I think I caught up with everybody. John's last question: DRI and Yum. I like both of them. Because, John, I'm not keen on economic growth, and not just in the United States. And Darden's more United States. Yum is international also. I'm not so sure that I want to jump in at the right time. Yes, if we get a dip, yes, I like both of them. DRI Darden has had a nice pop off of its lows, and it looks pretty good. If you want to maybe take a speculative run in now, if you don't already own it, yeah, I just put a very tight stop on there to get out, because if the market continues higher, and it just seems to want to defy the weight of the economic numbers, then maybe give it a ride. But I would keep a very, very tight stop on DRI. And the same with Yum. Again, you look at Yum in terms of the stock action, had a really nice bounce off the lows. It's come off. It's not where I would like to see it right now. And Yum, more so than Darden, tells me, because of the dip it just made recently, the last couple trading sessions, that all is not well and good with Yum. So I would hesitate to jump in to Yum. Darden, maybe take a shot with a very brief shot. I don't know how much upside you got. I don't think there's a lot of upside in there. I think the risk isn't worth it on both of those right now. At some point, I like both of them, but not now. Okay, come around to the couple of neat little. And I apologize for not taking you guys into the charts on these, for the simple reason I have metrics. I just don't want to pull up anything now and screw up the video setup. So was all set up for that, but my apologies yet again. CLIX. This is a real interesting ETF. Symbol is CLIX. It is the ProShares long online short physical stores ETF. So this is a pretty neat concept. It doesn't trade a lot of volume, but that doesn't matter. The spreads can get a little wide because there's not a lot of volume. But if you're in this at the right time and you catch a nice ride, if you take a look at the chart, it's had a tremendous ride because what it's doing, the underlying portfolio is long. They are 100% long online retailers, companies like Amazon, like Alibaba, that principally make their money selling online. That includes Wayfair, furniture. So any of the big online sellers are in their portfolio. So they're long 100% of the long. They're 100% long of those types of online retail. And we know they have hit it out of the park, and they are short 50%. And that's just the 50% is for margin purposes. Short 50% of retail stores that mostly sell through physical stores. Great simple concept. Wow, I love it. So CLIX, take a look. It's had a heck of a run. It's at all-time highs. At 68, looks like 68.90. Yeah, it's hit an all-time high today. Just a great idea for an ETF. It's fun to take a look at it, and I think it's something you want to look at in the future. Do I want to buy it right here, right now? Yeah, I think it's going to dip. If the market dips, I think it's going to dip. But longer term, I like to hold something like this. It makes a lot of sense to me. So CLIX, check it out. Another one, kind of neat one, is the long, high momentum names, short, low momentum names ETF. That's symbol is MOM for momentum. So MOM, it's the AGFIQ US Market Neutral Momentum Fund. And what it does, it's long a bunch of high momentum stocks that, and they gauge momentum by the last I believe 52 weeks. So what, and then I think they also have a rolling 12-week look at how is the momentum going. They're looking for stocks pretty much making new highs. The momentum is moving them higher, and there's some velocity to that momentum, and they're buying those, and they're shorting the ones that the momentum is going downwards, going in the wrong direction. Again, pretty simple concept. This one has very, very little volume. The spreads are a lot wider, but it's something to take a look at. It's just it's a fun concept. I'm surprised that if you look at the chart, you can see it kind of trades a little bit all over the place, and that's because there's just not a lot of volume. But you catch this at the right time, especially when the market falls. So let's keep an eye on this one. If the market comes down the way I think it come down at some point, this is going to be a really good play. Okay, and you don't have to worry about the volume in it if you get in low and just ride it up. You could have a really nice little ride on. So just some fun ETF to take a look at. The other one I want to talk about is OGIG. And OGIG is the O-Shares. That's Kevin O'Leary's company, I believe. That's the O-Shares Global Internet Giants. Now, again, smart concept. This fund invests in all the global online internet giants. Yes. You're an internet giant, you're Amazon, you're Alibaba, you're any of those big names, they own it. So again, I looked at the portfolio. It's all the big names you want to own, the international internet companies that have anything to do with the internet, that get all their business from the internet, that help drive the internet. Really pretty simple concept. Not, again, a lot of volume on this. Today the volume was 158,000, but the spreads are tighter here, so you can get in and out a little easier here. And I like this. It's a stock. It's as an ETF, it's done very well. It tanked like everything else when the market got hit, because everything is going to get hit with the market when it collapses. But the rise back up has been stellar, and for the right reasons. Don't forget, when we talk about the Nasdaq leadership, we're talking about these kinds of companies. So ETFs that concentrate in these kind of companies are exactly the kind of ETFs you want to take a look at. These specialty ETFs that make a lot of sense. One more I want to touch on, certainly not a buy now, but at some point it will be. JETS, Jets. This is the U.S. Global JETS ETF, all things jets, manufacturers of jets, leasing companies, everything to do with jets, airports, et cetera, et cetera. So anything to do, you can think of it, has to do with the jet airline industry, planes, air carriers, airports, et cetera, et cetera, et cetera, manufacturers. That's what JETS holds. Now, obviously, it's in the tank because, well, we know what's going on. There is no because the whole industry is in the tank. So this is scraping along its 52-week lows. It's going to probably continue to do that until the economy turns around. At some point, this is going to be a great buy. It's going to be a great long-term buy, and it's a pretty new fund. It hasn't been around a long time, but it's going to, I believe, have a heck of a run. So keep an eye on JETS, Jets. That's it for today. Thank you for bearing with me yet again, and have a great evening. We'll talk to you tomorrow. Cheers.